Okay, let's take a look. We have a previous video that deals with part of this, and we're going to repeat part of what we did, and then we're going to jump to another part of the exercise. This is kind of a long, drawn-out exercise where we have to do 1, 2, 3, 4. And in a previous video, we confirmed the bond price. We did that part of the. We're going to do that again, and then we did the journal entries. So if you want to know how to do that, should be the video just before this one. This part we're going to be focusing on requirements A and C. So we've got this, I don't know how you pronounce this, McCown or something like that, company, and they've issued some bonds. $300,000 of 6% face value bonds for a period of 9 years. And they issued these at $262,022. That means that's the amount of cash that they're going to be receiving. The liability amount is $300,000. The bond payable amount is whatever's on the face of the bonds. Why would you issue a debt for $300,000 and only get $262,22? Well, because similar bonds are on the market at 8%. So you can get more interest money, payment, income from buying other bonds. So how do you make it up to the customer? You say, okay, well, I'm going to pay you less interest, but I'm going to have you pay less for the bond. Okay, so this is what we call a discounted bond, or a bond issued at a discount. So it says they want something that you don't often see. It's quite common to have to take a $300,000 bond, use the percentage of stated interest rate and market rate, put the term in there. These are semi-annual bonds. That means we're going to pay interest twice a year, and come up with the present value, or the initial carrying amount of cash received. These are all the same things. But we've been given that. So they want something a little bit different. They want to know the present value of the principal portion, as well as the present value of the interest payments. And that's going to give us the selling price of the bonds. And we already know the selling price of the bonds. It's $262,022. So while we do have that figure right here, and we got it from right here, we don't know what the breakdown is. So probably the best way, let me toggle over to the internet, and I've already put these numbers in. And I want to show you this whole thing. We did this, it's cutting off, well, no, I guess it's got everything, doesn't it? We've got our face value of the bonds here. Our annual coupon rate, or interest rate, was 6%. Market effective interest rate was 8%, years to maturity 9, and it was very important that we click on semi-annual here. You can see the website where I found this calculator. There's plenty of them out there, and so we, we have a lot of figures here, a lot of information that we're actually going to use. If you watch the journal entry exercise that we did, we were making interest payments of $9,000. Now, we didn't need this calculator to do that, but notice the present value of the bond does come out to the exact figure that we were given in the question, and here is the breakdown for that. So make note of those numbers. We're going to use 148,088 for the present value of the principal, worded a little bit differently, but that's what it means. And then we're going to use 113,934 for the present value of the interest payments. All right, and again, these two figures add up to the 262,022. All right, so let's go ahead, if I can remember what those were. 148,088, and then this one was 113,934. Let's see, 6622. Okay, yeah, that's correct. All right. So Now we've got all of these T accounts that we have to deal with. And that's okay. Notice that we have a T account for cash, and they tell us that it's an asset, and hopefully we already know that. Bonds payable, liability, interest expense is an expense, and bond discount is a contra liability. Doesn't mean extra large. It means that it is a contra liability or an adjustment account for the liability account. All right. So, and they also were kind enough to date these items for us. So, what happens on January the 1st of 2016? Well, let's just start with cash because we've got it. We can just use this figure here. And cash is an asset, so we're going to increase cash on the left side. Then, we probably know this already, but the liability amount never changes. It's $300,000. So also on the 1st, we're going to come over here and we're going to record a $300,000 liability. And do note that I did that over here on the right side of the T account. We do not have any interest expense at the time that we issue these bonds because no time has passed. But we do have a bond discount amount, and we can calculate the bond discount amount using a process called subtraction. We're going to take the liability amount of $300,000 minus the cash received, and that's going to give us $7,978, and we're going to put that over here. So discount, bond discounts have a normal left side or debit balance. Okay? All right. So the next, that's all we have to do for January the 1st of 2016. When we get to June 30th of 2016, we are going to pay cash. And we saw the amount. It was on that website. It gave it to us. Well, we don't really need that because we know that we have a $300,000 bond, and we also know that it was issued at 6%. Now do recall this is a semi-annual interest payment, so we have to take that 6% and we have to have it. Okay, we're going to take that and we're going to multiply our 300,000. Move this a little bit more. So 300,000 times 0.03 is 9,000. But this is a payment. This is cash going out. So we're going to enter this over here on the right side because assets go down with a credit, or on the right. What do we do to the bond payable? Absolutely nothing. The bond payable amount must stay at $300,000 until such time that we pay it off. Okay? So what about interest expense? Well, it's a good question. What we're going to do is we're going to take the carrying amount, which currently is $262,022, and we're going to multiply that by 0.04. And that's going to give us our amount of interest expense. I'm going to add 12 cents to this. So that's what we're going to use. Where did I get that number? The 4%. I got it from the question. Market rate of interest is 8%, but because it's semi-annual, we have to cut that in half as well. I keep moving this page too far. Okay, so expenses have a normal debit balance. So we have 10,481 there. Now we're going to take this 10,481 interest expense, and we're going to subtract it from interest paid. We're going to subtract from the interest expense interest paid. So 10,481 minus 9,000 equals 1,481. And that's the amount of the bond discount that we have amortized, but we are going to put that over here. 1,481 is the amount of the discount that has been amortized. All right, now we have one more journal entry that we have to do, and this is where students often will start to sweat a little bit. Okay? We are going to make another interest payment of $9,000. The amount of cash paid is going to be based upon the liability, $300,000, times the interest rate, and of course in this particular case, as you've already seen, we used 3% instead of 6% because it is, again, a semi-annual payment. All right, so that's not going to change. Again, we do not touch the bond payable, but we do touch interest expense. But before we can do that, before we can calculate interest expense, because it's not going to be 10,481 this time, we have to adjust our carrying amount. So our initial carrying amount was 262,022. This figure right here, this right here, and they gave it to us up top again. However, that's no longer our carrying amount. We have to take the 262,022 and we're going to add to it this 1,481 here. We're trying to work our way up until we have a carrying amount equal to the amount of the liability. And so it's going to take us a while to get there. And we're not going to get there because we don't have to go that far. But 1,481 plus 262,022 equals 263,503. Okay, so that's our new carrying amount, 263,503. And we're going to multiply this number, not this number by 4%. Okay, and that's going to give us an interest expense of $10,540. And then since I'm going to use all whole numbers, I'm going to get rid of that 12 cents. And so that's what I recorded, 10,540, 10,540. And then the difference between 10,540 and 9,000 gives us the amount of bond discount that has been amortized. Okay? So, I think that you could do this. I think you could do this, and I think you can add two numbers together to see the amount of interest expense that we would record in the period. So the only thing that I'm going to do now is I'm going to calculate the current bond discount, and I'm going to do that by taking 37,978, which is the initial amount of our discount, minus 1,481 minus 1,540, and that's going to give us an ending balance of 34,957. And we could actually use this number, I'm going to clear this, but we could actually use this number to calculate the current carrying amount because it's no longer 263,503 after an additional 6 months has passed. It's going to be 300,000 minus 34,957 equals 265,043. So we can take the carrying amount minus the balance in the bond discount account and get the carrying amount, or we could take the initial carrying amount and then add the discount amortization to it. Either way, we're going to end up with 265,043. But this is strictly the carrying amount of the bonds, okay? Notice I have not touched this liability here, and neither should you. All right, well, hope you learned something, and that's it for this video.